Hey everybody, in this video I'm going to be covering for the TradeUI options tutorial, basically weekly expirations and day trading in that regard, and what I consider the best filters to utilize for that purpose. Of course, if you're day trading and you're looking for just quick scalps, very simply the best thing you can do is filter on the same week or next week expiration for the sweeps that are coming in. If you just want a quick reference and a shorter list, out of the money sweeps, pretty good to follow as well. I would recommend personally avoiding the ETFs and focusing more on the stocks because ETFs have a lot of money inflow, outflow, and it could be a variety of different strategies. It can get a little bit confusing. And then, of course, calls or puts, that's your preference. Historically, market tends to go up, so calls would be a better focus, but you can still focus on puts too, depending on the week and what's going on in it during all these catalysts and events. Wild market in the last couple months, so just something to keep in mind. Then, of course, all of that filters out, makes it a lot more straightforward, and then you just have a much smaller list. And then, of course, you could sort by things like the position size. Position size, obviously, the bigger the position size, the better, but that doesn't necessarily mean that the smaller ones won't be relevant. But as you can see here with Walmart's massive 2.3 million, and then you have the GSX at 828,000. And of course, different filters to explain what all that does. You can check that with the question mark there. Covers all of the different filters for that. I personally prefer the volume over open interest. So higher volume over open interest indicates more of a fresh position, whereas if the volume is under the open interest, might indicate a sale of that sweep, so it might not be relevant to what you're particularly looking for. Other things to consider is OTM is considered out of the money and it's considered a significant risk on a shorter term expiration day. So if you're seeing some sweeps coming in, and let's say you're on a Thursday trading day into a Friday trading day coming up, and then you are seeing all these massive sweeps for the Friday expiration, and that only leaves one day for that move to happen. So you're seeing a significant difference between the normal price and the strike price that might be way farther out. So let's say uh, SPY, for example, you see a 370 strike come in and it's only at 340. That's a big difference for a next day expiration, especially if it's 5 to 10 million or something ridiculous like that. Individual tickers, of course, are better than ETFs. In my personal opinion, you could still follow the sweeps for the ETFs, but it can get kind of overwhelming because they do a lot of money inflow, outflow throughout the day. And even on the shorter terms, so you might be considering a play, but that move might just simply be a small hedge comparative to the monies that they play around with, which is in the billions of dollars. So if they're only putting in millions, they're not exactly risking a whole lot in that regard for that hedge, especially on SPY. Of course, other things to look forward to would be that anything that's popping up for an earnings play or a catalyst that you know is coming up, or anything like that, that where you see an obscure ticker that's not usually there, but it's on a shorter term expiration. Those are good to watch as well. uh, Basically what I was saying earlier with the volume over open interest, higher the UOA, the better because it focuses on that aspect. And then, of course, the bigger the percentage move also as well from the spot to the expiration shows much more interest and a bigger directional move in that way. I hope that covers pretty much some of the basics of what I look for in that regard. If you guys have any questions, feel free to ask, and thanks for listening in and have a great day.